Last time we looked at how diversifying across asset classes could assist with reducing your overall portfolio risk. This time I illustrate an alternative technique, which is diversifying across assets within an asset class. Now, there are times when this won't work well due to correlation within a class, and I'll explain exactly where that's the case. But there are other instances, when undertaken correctly, where this technique can contribute significantly to your overall diversification strategy. Stay tuned. So, as I said in the introduction, last time was the first technique that we covered, which was diversification across asset classes. So let's now move on and look at diversification within an asset class. Now here, there's a warning. The component assets of some asset classes have high levels of correlation. And as we've learnt previously, diversification is only effective when your portfolio consists of uncorrelated assets. Now, probably the prime example of this is stock indices. Now here, they all tend to follow each other. So for example, if the Dow Jones goes up, it's likely that the FTSE 100 will go up, and vice versa. If the Dow Jones goes down, it's likely that other stock indices will follow. And so diversifying across multiple stock indices doesn't actually offer that much value because you won't be able to decrease the risk of your overall portfolio. But for other asset classes, that's not the case. Often within Forex pairs and also commodities, these are often much less correlated, and therefore these do provide diversification opportunities. So the example I'm going to use today will use 3 Forex pairs, so all from the same asset class. But I've chosen these carefully so that they have the minimal amount of correlation. And to do that, I've made sure that they're based on 6 different underlying currencies. And the pairs that I've chosen are Euro Aussie dollar, Pound New Zealand dollar, and US dollar Japanese yen. And I'm going to show you each of these trading the same system so that we can get an idea of the performance that we can get out of them individually. What I'll then do is start to combine them. So initially, I'm just going to trade Euro dollar and Pound New Zealand dollar together as part of a mini portfolio. And we'll look to see the effect that this has on the risk, which I'll be basing on the drawdown of those accounts. Then we'll go one step further and we'll add the third Forex pair in. So dollar yen will now be traded alongside the other 2 in the same account to get a single equity curve. So let's take a look. So as explained, the 3 charts we see here are for trading the same trading system against Euro Australian dollar, Pound New Zealand dollar in the middle, and dollar yen on the right. Now, the grey line you see at the bottom is the risk tolerance, which in these examples I've set at 10% below the high watermark, which is the orange line. And so the closer that the blue equity curve gets to that shows you how close it's getting to the tolerance of this example trader. So here, for example, when it reaches about halfway, this will represent a drawdown of approximately 5% on the account. So let's now start to look at what the effect is of trading these as part of a mini portfolio. So over here, I have a chart that represents trading Euro Aussie alongside Pound New Zealand dollar in that same account. And hopefully you can see that on average, the drawdowns look smaller than both Pound New Zealand dollar on its own and Euro Aussie on its own. And that equity curve just looks that little bit smoother. And we can now look at the metrics for this and see that the maximum drawdown for Euro Aussie was 2.9 and 5.1 for Pound New Zealand dollar. And just like we suspected, the drawdown from the combined portfolio is less. It's now 2.58%. And now by combining those figures with the compound annual growth rate gives us a reward risk-based measure. And we can see it was 0.85 for Euro Aussie and 0.44 for Pound New Zealand dollar, and overall that's increased to 0.89. So again, we're going in the right direction. But let's not stop there. Let's now add in dollar yen also. And here, this is the effect that we see. And once again, we see a reduction in those drawdown levels. So quantifiably, we're now down to a drawdown of 1.53, which is significantly better than all of the three individual components. And also look at the reward risk measure, 1.28. And this is compared to 0.37, 0.44 and 0.85 of the individual components. And so, although a very simple illustration, also a very powerful one that illustrates the advantages of trading assets even within the same asset class when those assets are uncorrelated. So in a similar way to last time, let's look at a trader on the Darwinex platform that's using this technique of trading multiple assets within an asset class. And once again, you can look at all of this information yourself. And so looking at the traders across the top here that have achieved the most investors in their trading strategies, I'm going to choose this one, ZVQ. So once again, we see a really nice equity curve here with fairly minimal drawdowns. And because of this particular trader has managed to attract 350 investors. And so they'll be earning success fees from those investments. So let's now take a look at some of the metrics, and of course the one we're most interested in is the assets that this trader is trading in their portfolio. So here we can see that the majority of the trades are coming from Aussie New Zealand dollar and also Euro SEK. But also this trader is trading Pound dollar, Euro NOK, Dollar SEK and Euro Yen. Now, for those of you that are new to the Darwinex platform, there's a concept of investable attributes, and each trader on the platform gets rated for each of these. Now, this, of course, is valuable information that's available to investors so that they can see the details of the trader that they are backing with their investor capital. But also, they're incredibly useful to the trader themselves. So as you know, I trade myself on this platform, and one of the most useful metrics that I've talked about on previous occasions is this rating of the open and close strategies. And this provides information that lets you know what would have happened if you'd entered your trades slightly earlier, and what would have happened if you'd entered them slightly later. And it actually tells you the impact on the performance of your system based on those differences. So the white line you see here is what actually happened for this trader, and this top chart is for the open strategy, and then likewise below for the closed strategy. And by hovering over, you can see the specifics about whether you'd have benefited from entering slightly earlier on average or slightly later. Now, this is just one metric of many that are on the platform. And so this is maybe something you'd like to consider in terms of linking your existing broker's account with Darwinex so that you can get access to some of these metrics. Now, by opening up a full Darwinex trading account, you do get a much wider selection of metrics available to you. And of course, you would need to do that if you wanted to attract investor capital. But hopefully that was a good illustration of a trader who's using this technique that we've talked about today in terms of diversifying across assets within an asset class. And in this case, of course, it was that Forex asset class. So next time we're going to look at yet another technique for diversification, and this will be diversification across time frames. So be sure to tune in for that. If it's already available, then you can see it here top right. If not, then please subscribe and you'll be notified when it becomes available. Please remember to give me a thumbs up, guys, and until next time, trade safe.